fewer and fewer people are predicting a recession. There's talk of a soft landing. There's talk of the Fed may, the economy is still strong. We haven't seen, and everyone talks about the lag effect of monetary policy, right? So it could be we just haven't seen it yet. But for the time being, the consumer's still spending. The economy is very strong, and it's hard to see the Fed lowering rates anytime soon.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome to this podcast from Interactive Brokers. Joining me, Andrew Wilkinson, to discuss the disruption in the US Treasury market of late is Head of Electronic Fixed Income Trading here at Interactive Brokers, Joe Burke. Welcome, Joe.
Thank you, Andrew. Good to be here.
So, Joe, can you put into context the rough ride investors have faced during the past month and identify what's caused it? How have yields moved? Give us some sense of the magnitude of the problem here.
Sure. I mean, if you look at the yield curve overall, and I tend to look at the 2-year versus the 10-year, the yields on the 2-year note in the last month or so have moved from 498 down to 464, back up to 498, which is a fairly large move for a short-term instrument. The 10-year, also a little more volatile in general, given the maturity, but 407 to 375, back to 434, which is up near a new high.
That's the highest in what, Joe?
It's 2007, I think.
Wow. So about 16 years.
Yeah. So, and if you look at like the 2-10 spread, it's inverted, as you know. It went from 90 basis points to 104 down to 65. So, just big moves, and it's just a lot of volatility for many, many reasons.
So, what's changed? Are we suddenly expecting more interest rate increases from the Fed?
No, I don't think so. I think the Fed has stated they will be data dependent, and the market is predicting that there will be one more Fed hike, most likely next month. Most likely in November. No hikes expected in September. But so you're not looking for an additional hike. You can't rule it out. But there are a couple of factors that come into play here, and one of them is supply. The Treasury really surprised the market when it announced that the size of the quarterly refunding was how big it was going to be, and how much cash it needed to raise. Also, the economy continues to impress. It's very strong. The other thing is on July 31st, if I'm not mistaken, the Bank of Japan raised the cap on their bond yields from 50 basis points to 100 basis points. And the concern there is, the reason that spooks the market is because Japanese investors are big buyers of U.S. Treasuries. If the Bank of Japan is sort of loosening that cap and allowing rates to rise, then Japanese investors will be incentivized to buy Japanese bonds and fewer treasuries, which would cause yields to rise.
So you've not only got the issue of more supply in the United States to fund a yawning deficit, but now Japanese buyers are more interested in buying Japanese bonds.
Correct. And I would add one other thing there, or two other things really. There's a higher inflation premium being demanded by investors in general, given how much we've seen rates move in the last year and a half. And secondly, dealers are committing less risk capital to the market. So, if they're going to execute trades on behalf of clients, they're getting in and out of those positions first. There's nobody there sort of backstopping the market. They'll trade out of it as quickly as they can, and that increases the amount of volatility in the market.
So we've had this recent phrase, higher for longer. I think they call it H4L. Is the market getting used to this now?
I think so. I think that's it's going to be hard. The Fed may not go much further in terms of rate hikes. Maybe just one more, maybe two. Who knows? But the expectation is going to be that the rates will stay there for quite a long time.
What on the economic front is leading to support the view that interest rates need to stay higher for longer? I mean, we've looked at the labor market, but we've also been focused on a recession. Is the recession coming? Is that also behind this?
Fewer and fewer people are predicting a recession. There's talk of a soft landing. There's talk of the Fed may the economy is still strong. We haven't seen, and everyone talks about the lag effect of monetary policy, right? So it could be we just haven't seen it yet. But for the time being, the consumer's still spending, and the economy is very strong, and it's hard to see the Fed lowering rates anytime soon.
So the yield curve has gone up at the front end, but they're really expecting the same number of hikes, but it's just that the back end has really taken the
Correct.
pain here.
Correct.
So can you elaborate, Joe, on the impact across the different bond markets, maybe treasuries, corporates, or munis? Where have people been getting hurt?
Well, in corporate bonds, well, certainly in treasuries, it didn't necessarily get hurt, but there was certainly a lot of volatility. So your point of entry and exit is very challenging to pick because you can easily get whipsawed in the marketplace. As far as corporate bonds, investment grade corporate bonds basically track stocks. So if stocks go lower, credit spreads will widen out, and corporate bond prices will go lower. I don't really see much of a correlation with munis. That's kind of I think that's about it on that.
So, Joe, is the treasury market leading the stock market lower in that sense?
I think they're independent. I don't think that they're really that highly correlated. I just think the volatility in the treasury market is problematic. I don't see it necessarily leading the stock market, but the stock market does lead the corporate bond market.
And again, economic strength kind of filters through here. That seems to be the
Right.
winning trade, right?
Right.
So finally then, with yields at the highest in, what did we say, 16 years,
Yeah.
does it feel like the bond market is currently a good place to be?
Well, there's certainly a lot of interest in capturing some yield. And, treasuries, if you buy shorter duration treasuries, you're going to get your money back in some reasonable period of time, and you're going to capture some yield along the way. So there is definitely some appeal to the shorter end of the curve. As far as the longer end of the curve, from a personal standpoint, I don't know that the Fed I think it's going to be very hard for the Fed to get inflation down further from here. And I don't know, when you give them the strength of the consumer, are they ever going to stop spending? I mean, you go out anywhere, just go out locally to a restaurant or a shopping center, and the number of people out and spending is just incredible to me. And then, the other thing that concerns me is, with higher interest rates and all this borrowing, our deficits are getting much, much larger. I don't know what the long-term implication of that is for the economy overall and for the market, but it certainly is something that would make me worry.
My thanks to Joe Burke. Thanks for popping in, Joe. Don't forget to check out more of our podcast channel and to leave us a review wherever you download your podcast from. Thank you very much, Joe.
Thanks, Andy.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at ibkrpodcasts.com. And if you're interested in learning more about interactive brokers, visit ibkr.com. We offer more trading education material, such as webinars at ibkrwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.